Are you out looking for your dream home, but you're worried about your mortgage application being denied? Don't panic. Today, I'm going to share with you some insider tips as a mortgage underwriter. I've been a mortgage underwriter for 20 plus years, and the purpose of this video is to help you avoid the common mistakes that folks make to ensure that your loan application gets the green light. Um, my name is Hailey. If you're first time to my channel, welcome. If you've seen any of my other videos, welcome back. And in this video, like I said, I'm going to guide you through that beginning step. Well, actually, it's the second step to your mortgage application being approved. Of course, the initial step is usually a pre-qualification, and that pre-qualification process is totally focused on looking at your credit. So if the point here is the assumption is your credit is okay and that you're looking at that initial loan application. So, but before we get into that, I just, just think about this. Buying a home is a big step. It's a major step for many of us. Especially the first time, it's a major life journey. It's a major life step. We're going from being tenants, living in someone else's home, to owning our own, having our own nest, as you know, as the saying goes, and having that opportunity to own something on your own when nobody can tell you what to do outside of the laws, of course, in terms of code violations and things of that nature. But it's yours. You can paint the walls any colors you want. If you want stripes, you want red and black, blue and white. It's a beautiful thing. Having owned several homes myself, and I'm not speaking on investments. I mean, actually moved in my residences. Me personally, I always found it fun when I get in that new house, not brand new. I've never had a brand new house, but and just basically renovating it and making it my own. Maybe at some point I'll show some of the stuff that I've done. I've never really recorded a lot of the work I did because I wasn't turning on the camera back then. But when you're getting your home, it's exciting to decorate. It's exciting to think about colors and thinking about those choices and all of those things. But before we get to that step there, you want to be prepared to guarantee that your mortgage is going to be approved so you can get into that house. And preparation is the key. It's large, it's huge. It's a big difference between being able to close on your house in 30 days, 30 to 45 days, and taking longer due to some steps. Now, I've been an underwriter for over 20 years. And for those of you that don't know, the underwriter, we are the folks who take a look at your full mortgage application. We look at your credit report, scores, of course. We look at your credit report, though. We're looking beyond just the scores. We're looking at your actual credit file. We're looking at, even if you had a decent credit score, but we will look at things like collections. We're looking to see if those collections are substantial in size and dollar amount, because we're always concerned about certain things, like liens that could go on your new home after you buy it. But the full mortgage approval process, we're looking at the three C's. We're looking at collateral, which is the house itself. We're looking at cash. We're looking at your reserves, your assets. We're looking at your capacity, was what we call it, but that's basically just a fancy word, not fancy, but a different way of saying income. So we're looking at your income, we're looking at your assets, and then we're looking at your credit. So this video, I'm gonna tell you how to avoid a denial. So a straight up denial, because you'd hate to go through the process of applying for a mortgage. You get excited. You get into pre-approval usually, and this is a full pre-approval, not a pre-qualification, which is what we talked about with just credit only. This is pre-approval, where we're looking at your income, and then we can determine how much house you can afford based on how much loan money you can borrow. So we have to look at your income and something called debt to income ratio. but we'll get to that. But it is crucial that in order for you to get a smooth transition and get an approval, I'm going to tell you exactly what us underwriters are evaluating in that mortgage review, in that application review. Our main focus is on those three things. So let's talk about credit first. Well, of course, you guys know I work in the credit space, and I'm doing risk is what our business is. And so obviously you've seen the other videos. If you haven't, check those out where I talk in depth about all things credit. But keep in mind, in the mortgage space, I'm going to go a little more deeper, less about the credit, because we're going to assume that your credit is good enough for the minimum standards. But the thing is, though, there are three sets of standards. In mortgage lending, there are various ways, various programs, I should say, and each of these programs they all have different guidelines. There's FHA. I'm sure most of you have heard of them. FHA. There's Fannie Mae, there's Freddie Mac, and then there are which most people have heard of. Most people have heard of Fannie Mae. Most people have heard of FHA, but Freddie Mac is very similar to Fannie Mae, but Freddie Mac cares more about higher credit scores than Fannie. But then there's also programs like USDA. I know people, when they think about USDA, they think about like meat and stuff, but USDA has a program and that's geared more towards properties that are in rural areas, farm areas. May not be a working farm per se, but maybe it used to be a farm, but some people like to live in a farmhouse type home with ranch, with a ranch feel with barns and stables and things like that. It can't be a horse ranch or anything, and it may have some acreage to it, and so USDA kind of covers that. And then of course there's the program that's specifically for our veterans. Thank you for your service. The VA lending program, which is very liberal in terms of down payment and things of that nature. All of these programs have different minimum guidelines for income, the debt to income, income, and then your credit, which forms your debt to income ratio. They all have different guidelines for that, and so you'd have to kind of know that. And then, of course, for you to get a VA loan, you got to be a veteran. But all the other programs have no restrictions other than USDA is kind of geared for. It's not really a restriction, but it's for that type of property, Fannie and Freddie, and it's mostly the properties that FHA, Fannie Mae, Freddie Mac won't do. Now, when we talk about a question a lot of people ask about is things like, oh, low money down, no money down. FHA, they go as low as 3.5% that you have to put down, and then of course on top of that you have closing costs, and but the down payment portion is as low as 3.5%. Now, typically with Fannie Mae and Freddie Mac, they have normal programs that can go as low as 5% down, and then of course there's closing costs that you would also have to come up with. Now, with owner occupied transactions, I mean, you guys, I'm speaking mostly to you guys that are looking to buy your first home to live in. We're not talking about investment properties. They have very minimum reserve requirements, and what reserves is basically the money you got to have on the side. But again, on the credit side, FHA, Fannie Mae, Freddie Mac, USDA, VA all have different guidelines when it comes to the credit qualification part. Now, most of these programs, FHA will go as low as 580 credit score. However, many of the actual banks, what we call the investors that will do the loans, when we're as a broker, they're shopping the loan around to get to a bank to get the loan for you. They may have what we refer to as overlays, where they say, sure, FHA, they'll go as low as 580, but we don't like to submit loans to them because that's a minimum score. But the particular bank that the loan is going to be made by them directly, because FHA, Fannie and Freddie, those are guarantees. They're basically guaranteeing that if they submit the loan, they guarantee that it's fine. We'll accept it as is. Um, and then FHA is sort of has an insurance component too. And then Fannie and Freddie have a private mortgage insurance component, which I'm not going to get to that yet. But just know that whenever you put down less than 20%, mortgage insurance of some kind is necessary. It's built in with FHA through the government, and then it's private mortgage insurance. But again, I got to that part yet. I'm talking about credit. My point is that the investors have minimum overlays. So even though FHA may say we'll take a credit score as low as 580, the investors say, yeah, but we don't want to submit loans that low because we don't like the risk at 580. So they may say 620, 600, 620. So that's sort of the confusion where some folks, they say they've read that FHA will go as low as 580, but then when they do a pre-qual and their score is above 580 but less than 620, the lender says we won't do it at that. Your score is not low enough. We like to see it higher. But there are some lenders out there that will go to that FHA minimum of 580. Now, of course, at that minimum score, your interest rate on your loan is going to be significantly higher than if you had a better score, which is going to make you have a higher payment. So credit is still a factor. Again, I've discussed that in other videos and other series, so you can take a look at that for more details. Now, Fannie Mae has a program called Home Ready, which is very similar. And then there's those are and Freddie Mac has a Home Possible. Those programs are for folks who want to buy a home and fix it up themselves. They're, there are loans for that as well. So, but basically, from an underwriting standpoint, when you get a live loan in front of you, anything below 620 is usually going to raise a red flag in the underwriting department on that file. But that doesn't mean we're going to say no, because we can look at the things in the other two components. Remember, I told you there's credit, there's income, and there's assets. And so you could have, if your credit is weak, but it's good enough to meet the minimum, you could have things like what we refer to as compensating factors. Like, even though your credit is low, you could have an extraordinarily high income, which will basically give you a very low debt to income. If you got a high income and not a lot of bills on your credit, and so your monthly debt is low, you could have a really, really low debt to income ratio. That could help as a compensate against the weak credit. Also, as a compensating factor, you could have a large amount of reserves. I mean, you could have a large 401k balance, a large investment balance with something private, a mutual fund or something like that. You could have a large balance in your bank account. And so if you got thin credit, but you meet the minimum guidelines, and you could have a low debt to income ratio, or you could have a debt to income ratio that's right in the middle. The excessive reserves, because normally with reserves, we like to see three to 6 months, minimum 3 months. The guidelines will usually say 3 months reserves, but on owner occupied, you may only need 1 month reserve in most of the programs. But if you got more than 1 month, every month that you have more than one is a compensating factor. So the beauty of, you know, mortgage lending is your loan is always going to be reviewed by a live person, and we're going to look at everything as a whole. So you get a human being who's making a judgment based on everything they see, and that's a lot better than other lending facilities, other lending types like credit cards and car loans. A lot of that is they just run it through a system, and you have a machine just basically an algorithm and making a credit decision. With us, you got a human touch. So that's something to be said. But as an underwriter, judgment is basically our tool of trade, our stock and trade, because we have to make decisions. We are expected by the banks and Fannie Mae and FHA, Freddie Mac, and so on. They're expecting us to look at your entire application and make a judgment. And so we need to judge that, we need to judge that accordingly. So going to the second section, which is the income. Now, of course, on your application, along with your application, we need to see your application with the credit report. We also need to see your income documentation. Now, we always want to see your most recent bank statements. Your most recent pay stubs. If you get paid every 2 weeks, we like to see a month's worth. We like to see a total of a month. So if you get paid weekly, we need to see 4 weeks. When you get paid every 2 weeks, we want to see two to make up a month. 2 months is even better because we like to, especially if your salary, if you're hourly or salary, then we look at it and we make a calculation to determine what your qualifying income is. I'm not going to bore you with the math on that, but we calculate qualifying income. And so we verify that with pay stubs. We also verify your income over the last 2 years with your two most recent W-2s for your last 2 years. We like to see those. So if you're a payroll salary employee, that's what we look for. If you're an independent contractor and you don't get a payroll check, you just may be getting checks. And then at the end of the year, you're issued a 1099. We want to see 2 years of that, the 1099. We'd also like to see those same bank statements that we see to determine your assets. Well, I'll get to that for reserves, down payment, closing costs, reserves. We also would like to see that income that you receive by check showing up in your bank account being deposited. So then we would want additional pay stubs, bank statements above and beyond what I'll tell you we need when I get to the assets section. So pay stubs, W-2s, 1099s, and possibly bank statements can all be used to verify income. So you want to have those. You want to, those are easy to get to, especially nowadays with most folks having electronic profiles and portals that they can go in and pull up those statements. And so keep those things handy, have those all together, clarify. If there's anything if there are any odd deductions that are not clear to the underwriter, they're going to ask about them. If we see deductions for things like child support and all that, then we're going to ask about child support. If we see deductions with kind of vague descriptions and when it's line itemed on your pay stub, we're going to ask about those as well. So be prepared to answer those questions and provide documentation. Because there's a saying that we have in the underwriter business. We say trust but verify. So we trust that the borrower, the applicant, I should say, is telling the truth, but we want to verify everything with the proper documentation. So when it comes to pay stubs, if there are deductions that are odd to us, we're going to want explanation for them. And I say that because with the income and the assets, the documentation that you provide, you'll save yourself a lot of aggravation and a lot of time when you have all of that stuff in the file ahead of time. Now, the beauty of it, if you're working with a knowledgeable and experienced mortgage loan officer, they've worked with underwriters like myself over time. They will look at that stuff when they get your documentation, and they will tell you in advance of your full application, hey, can you get this? Can you get that? And they're doing that. They're not trying to add barriers. What they're trying to do is be prepared for all of our questions that we're going to ask. So if they look at your pay stub and they see a weird deduction, and then they say, oh, that you tell them, oh, it's this, that, or the other, and they say, oh, you got paperwork for that, you definitely want to provide that. And so to explain all of that there. Now, the third component that we're going to look at in your mortgage application is your assets. Assets being money, cash, investments, things that and the assets we want to know for a few reasons. Number one, we want to know, well, besides from the income part, if you're an independent contractor, we may look at bank statements to verify the income you got because you don't have payroll checks. And so we're going to ask for for the asset part, we'll ask for 3 months bank statements. Now, if we need it also to verify income, we may ask for a full year, 12 months bank statements, or year to date. If like say, depending on what time of the year, if it's 9 months into the year, we'll ask for 9 months. So we'll ask for all the bank statements within the calendar year that your application is being reviewed. So if we're looking at your application in March, we want to see 3 months bank statements and then the other income documents that for the last calendar year and the year before. But for down payment, cash, closing costs, and reserves, we normally want to see 3 months of your bank statements, at least 3 months in any 401k accounts that you have. So if you got 401k balance, definitely provide that. If you have any other mutual funds, that's 401k being retirement, a mutual fund may be non-retirement. Any money there, you want to show us, you would want to give us that. Pensions, not so much, because we know a lot of times with pensions, they can't be liquidated anyway. So we know you can't take if you got a defined pension through your employer, you can't cash any of that in. You may have some options for borrowing money against something like that. But in terms of your documentation, we want to see 3 months bank statements. We want to see at least a quarterly invest 401k statement or mutual fund statement. And so we want to see that you got enough money for your down payment, any projected closing costs, because at this point we don't know exact numbers, and reserves. Now, as I spoke a little bit earlier, most of the loan programs, when it's an owner occupied home, you usually only need 1 month's reserves. Sometimes the guidelines have additional reserves baked in to offset some of the other weaknesses, like I said, compensating factors. But the beauty of it is, even if you're fine on the minimum score, your credit's good, and your income is good on the debt ratio, the more reserves you got, the better. Because again, as an underwriter, we love to see compensating factors because we're trying to measure risk. And so if we're thinking you're a little bit thin on the credit, or you're a little on the high end of your debt to income ratio, but still within the guidelines of the program we're trying to put you through. If you got a huge amount of reserves, like say you got $200,000 in your 401k, and so now you got 10 years of reserves, so to speak, that's a huge compensating factor that helps us to lean your way towards the approval. But you definitely won't get denied if you got reserves. You definitely won't get denied if you got a job, and you definitely won't get denied if you got the minimum credit score. So tips to avoid a denial. And speaking of which, right, here's the pitfalls. Obviously, the credit piece. You won't get denied if you got good credit, because that's our goal, really. Because even though, yes, I talked about minimum credit score 580 with FHA, could be 620 with Fannie and Freddie, USDA, so on and so forth. But the problem with minimum is that even if you get an approval, you're still not going to get the best rate. For example, if you were trying to borrow $160,000 and you had that 580 minimum score for FHA and possibly the Home Ready or Fannie's Home Ready, Freddie's Home Possible programs, and they say, okay, yeah, you're approved, but and then the broker is going to tell you, I'm just using this for example in the current market climate. Say, for instance, they say, okay, yeah, you got the 580, you meet the minimum, the underwriter gave you an approval, and your interest rate is going to be 8.5%. Right now, that on $160,000, that 8.5% at for 30 years is going to be $1,153 a month just for the mortgage part, not even taxes and insurance. That's just the loan part, all because you got the minimum score. Now, of course, you want to have a better score, because even if you just increased your credit score to 620, you could be eligible for interest rate, say 2 points lower, 6.5%. That's just 2 percentage points lower. That changes that same $160,000 loan. The payment is now $983. So that's about $205 a month lower just by having that much better credit. So you say, okay, that's huge. I mean, $200 a month for 30 years. At least in the first year, that's over $2,400 a year in high and lower payments just by having just that much better credit score. But on top of that, if you took the loan to 30 years, which I know a lot of times people refinance and things of that nature, because you always have the option to refinance. If you can't get the best rate now, if you work on your credit and fix your credit, then you're maybe possibly eligible for a refi later. I personally think that it's better to get the best rate up front, and save your refinance, not for other things. I know my mortgage buddies out there tell you, no, refinance is always an option, which it is. But if you can get the best rate in terms the first time, then then it can only get better from there. And so $200 a month, that's $2,500 just in the first year. But that, even if you took that loan to 30 years, that's $73,800, I think, more, just by not having a better credit score now and not getting the best rate. So monitor your credit, fix your credit, restore your credit, whatever word. I like to say, I like to think of restoration over repair, because restoration means a total revamp. It's the difference between restoring your house and patching your house. And so I think credit deserves the same respect, and it's more valuable. Personally, I think someone whose credit has been restored, their credit is much stronger, healthier, and of more quality than somebody who just tacked at certain little things to bump their score up. But you still look at their credit, you still seeing collections and late payments and all of that stuff, even some charge-offs, even though their score is just good enough to get their approval. It's still not quality. I mean, you want to see a file with no negative remarks at all. That's what restored credit looks like. So if you want to, we like to see the credit utilization ratio in line. For those of you that don't know what that is, take a look at some of my other videos where I talk about credit utilization. But essentially, it's basically you're only using 30% or less of your available credit limit on any of your credit cards or lines of credit, and that helps boost your score. It looks good. It's you're showing conservative and responsible use of credit. And of course, obviously, you want to not have late payments. You definitely don't want that. So tip number 2 is your job stability, because we talked about the income, right? So having the right amount of income to have your debt to income ratio, which your debt to income ratio is the amount of your bills divided by your total gross qualifying income. So we go by gross, not by net, for mortgage qualifying. And so oops, phone's ringing. And so sorry about that. And so you definitely want to have your job stability. I mean, in today's age, it's not terrible if you change jobs, because we know today job mobility is even higher now. But job mobility has been accepted. But we look at things like, what's more important is like line of work. If you've changed employers, but you've been generally in the same line of work, that we're not as super concerned about that. The main part we're concerned in those situations is when you have job mobility, that we generally like to see the same line of work and we want to see the income the same or rising. We're always concerned if we see a job change and there's a decline in the income, because then we're concerned about that. Now I know even especially today with wage pressures going up, it's especially a red flag. Doesn't mean it's going to be a denial, but if you do have declining income, you may get denied. We may need more time, or we'll scale back and definitely reduce the amount of loan you can borrow. So that's going to reduce the amount of house you could buy, which would essentially could put you out the market. If you can only borrow $100,000 and you're trying to look at a $200,000 neighborhood, that's essentially a denial of sorts. So make sure your job stability is together. But here's the thing, again, the beauty of being underwritten by a human being. If there's something odd, have that explanation. Be ready to explain. If you had a job change, if there was something happened, did you have a sickness? If you had a job gap, say you were off work for 6 months or longer, have an explanation for why you were off for 6 months, and have that in the file, because we're going to ask. And underwriters, we love it. I'm going to tell you, we're human beings. We're biased. When we know we're going to see these eyeball things, these inconsistencies, and when they're already addressed and in the file, we're happier. We hate when we have to write a whole bunch of conditions and then go back and then wait for you to come back and explain it when we know you knew about it all along. So if you want to avoid a denial, have your documentation, have your explanations in there proactively. Don't wait for the underwriter to ask for them. I know some loan officers will tell you, no, we'll let them ask for it because they think they're gonna. We may forget or overlook it, and they think that by explaining things up front, they're gonna tip your hand with us. But I tell you, if you want better chance of avoiding denials, better chance of approval, have the documentations and explanations for eyeball situations up front, exceptions, rules like that. Tip number 3, make sure that you got a low debt to income ratio. Again, I spoke on that earlier with the income piece. You want to make sure that you're living well within your means, because remember, we're qualifying you with gross income, not net, not your take home pay. And so you have to keep that in mind too, because even though we're qualifying you with gross income, you got to make your payments. Your budget is based on your take home pay. So don't be careful in trying to over borrow to more house than you can, afford long term. Now, of course, the future, if you're upwardly mobile, then your income's going to increase over time. So that may be okay, but just keep that in mind with consideration. But again, if you want to avoid a denial, make sure your debt to income ratio is low versus high. Okay. And if you need to pay down some debt, because remember, we're not looking at the debt to income ratio is all about balances. I mean, it's not about your balances, it's about your monthly payments. So don't make the mistake of going around thinking you got to start paying down balances if they don't significantly reduce your monthly payment on those. Because sometimes, you might have $1,000 credit card balance and they're showing you a monthly payment of 65 bucks. Paying off the $1,000 is only going to reduce your monthly debt by 60 bucks, and that's $1,000 that could have been used towards your closing costs. So be careful when you're trying to pay off debt to try to lower your debt to income ratio. If you're going to do that, focus on things like paying off an installment loan that might have a low balance and to get rid of it, because the installment loan, it might have started out at $5,000 and then you had a $200 a month payment, and now you're down to the last $1,000 on the balance to pay it off, but you still got a $200 a month payment. So by paying off the $1,000 on the installment loan, now you get rid of a whole $200 payment, it's done, it's over with, and now your debt to income ratio goes down. So you got to think strategically when you're paying off debt to try to lower your debt to income ratio. Don't pay off balances. Don't pay off a balance on an account that has a low monthly payment anyway. You're not really helping your DTI. You're reducing your debt and things and your and utilization, things like that, but you're not helping your debt to income ratio. Have your monthly payments lower in that way. Tip number 4, document everything. I've said it before a few minutes ago. Document everything. You know, your credit report is a document. We're going to look at that. You know, the lender is going to provide that, but that's a document we want to see. Any income, all your income, any income that we can determine what can be used for qualifying. Overtime, document it. Extra income, side income if you want to use it. If it's consistent, stable, you got a 2-year history, things of that nature. Any extra income, but you got to document it. Document it. Oh, and I forgot to mention too, on the income side, I didn't mention tax returns. You got to have 2 years tax returns as well. Be ready to provide them. Sometimes you don't necessarily need them because if you're a salary and if you're a wage employee, whether salary or hourly, the W-2s may be enough. We may not necessarily need the tax returns, but if you're an independent contractor, we're definitely going to need them. If you're self-employed, we're definitely going to need the tax returns. But if you're a wage employee, you don't have to. You provide them. The broker may or may not submit them to us. But if you have the W-2s, you definitely need. But don't forget about tax returns. That's another document. All your assets, your bank statements, have those. You got to have them. So there's no way around them. You got to have them. If you want us to include your retirement for reserves, provide the documents. Document everything. If you are divorced, we're going to need a divorce decree. So we know that any other considerations, if there's anything on credit that was that might show up on credit, but it was your ex-spouse's responsibility, the divorce decree will tell us that you're not responsible. If there was a previous home that you both lived in and the ex-spouse got the other house, but the mortgage is still in your name, the divorce decree should say she or he is responsible for the old payment so that we can disregard that mortgage payment that might show up that might be on credit. It's probably on credit if you were on it. We don't have to count it in your debt to income ratio because the divorce decree, the court said that no, that's her responsibility. So we need that. If you got that situation up front, provide it. Get the divorce decree, have it in the file so the underwriter doesn't have to go and ask for it later. Because a lot of times we always think, why didn't they just give us that? They know it's here. They know it exists. So again, a good mortgage loan officer is going to tell you up front a lot of the things that I'm telling you right now. But I just want you guys to be educated on as well. And if they're not telling you to provide these things, you're probably not using the right loan officer. Go get somebody else. If you want some recommendations, you can put it in the comments below. I can definitely point you in the right direction to some good companies with good guys that are knowledgeable in the mortgage lending arena. And so tip number 5, this one, although it's very general in its nature, it's probably the most important ones because another huge concept that we as underwriters is we like to see consistency. Because even though I talked about the job stability, we like if you've changed employers, we at least want to see a consistent line of work, right? If your line of work has changed and the employer has changed, maybe your line of work changed, but your employer stayed the same. You move departments, work in a different job function. That's still consistency. But if you're inconsistent, you've changed jobs, you've changed lines of work, they got to kind of make sense in terms of a natural trend progression from one to the other. So some level of consistency. Your income level, we like to see the dollar amount consistent. Your bank statements, we like to see consistency. Your income, when we look at W-2 year over year, we like to see consistency see in terms of either your income that's the same from year to year or is going up. When we see declines and we see inconsistencies, we always ask for it, and we always ask for documentation. But most of all, prior to mortgage application, avoid major financial changes. And again, what do I mean by that? If you're thinking you don't, it's probably not a good idea to make a lot of large purchases right before you apply for a mortgage. I mean, I would, if you buy a car, I would try to wait at least, if you had to go out and buy a new car, when I mean new, not necessarily brand new, but new to you. If you buy a new car, I said, if you're going to do it, I suggest you do it at least 6 months before you plan on applying for a mortgage, because it's a big ticket purchase. We want to see 6 months of payments that you're handling that new expense. And it's already showing on your credit and it's documented on your credit. That's one reason why. Any other major financing, generally speaking, within 6 months of your plan to apply for a mortgage, don't go out and buy a new car. Don't go out and buy a boat. Don't go out and make a large purchase, or go out and buy. You say, oh, I'm buying a house, so I'm going to buy all new furniture now. And then you go to one of the big places and you finance $15,000, $20,000 worth of furnishing because you're buying furniture for the house you haven't bought yet. I recommend don't go buy a motorcycle or a boat or any of that stuff 6 months before you plan on applying for a mortgage, because all that new credit, and on top of that, it shows a lot of instability. And so we're going to think twice, or have a pause and major concerns about, now you're going to add on to this new car, new bike, new motorcycle, all this new furniture with a whole new mortgage. Which brings me to another sort of a concept that we talk about in mortgage lending, and part of that underwriting process is something called payment shock. Basically, what payment shock is when we look to see, like, whatever your rent that you're paying now, and then we look at your rent payment, and then what is your new proposed mortgage payment going to look like. That's the principal and interest on the loan, and plus your taxes and insurance on a monthly basis, because we require escrows. You're going to have your taxes for the year broken down into 12 payments, and your insurance premium broken down into 12 payments and added to your loan. So you have what's called a PITI. Your mortgage payment is principal and interest on the loan, and then taxes on a monthly basis, and insurance on a monthly basis. And then on top of that, if you've taken advantage of FHA or Home Possible, Home Ready with Freddie and Fannie, or even, and then you're required to have mortgage insurance. That's going to be an extra payment on top of that, because that's insurance. And mortgage insurance is basically insurance that protects the lender against you defaulting on the loan since you put less than 20% down. So you're going to have a PITI and PMI or MIP if it's FHA. And so they're going to, if say your rent was $600, and now you buy a house, and now your payment's $1,000. So we look at that to see beyond 40% higher, how much of a payment shock that is. And again, if that payment shock could be higher, but if your DTI is still low with that new proposed payment, we consider the payment shock less than if you were going from $600 to $1,000. Or say if you were going from $600 to $1,000 and your DTI is over 50%, you may get denied because your DTI is too high. But if your payment is going from $600 to $1,000, and then you got reserves, that may offset that. But typically, it's hard to offset a DTI that's over the guidelines, because the different lending programs have guidelines about maximum debt to income ratio. So that way, and if you have extra money, you may have to pay off some bills in their entirety and close them out to get your DTI down. Hopefully you're paying off installment debt, because paying off credit cards, they kind of don't look at it the same way, because we know you'd have to pay them off and close them so that we know you can't run them back up and that DTI remains at the new level. But the problem with that is you run the risk when you close credit accounts, it may negatively impact your credit. So typically what you want to do, if you're going to pay off debt to reduce your debt to income ratio, you want to be paying off installment loans that are over and done with, because you're getting rid of the balance, you're getting rid of the payment, lowering your DTI. And we know installment loan, once it's paid off, it's done. Otherwise, it would be involving. So don't make those big changes. And obviously, it's really difficult to qualify for a mortgage, depending on your situation, if you're in the midst of a divorce. So you typically you want to get the divorce finalized first. Think something like that before you apply for, a mortgage, because you want to have it clean and simple. The cleaner your file is kind of what we call in mortgage underwriting as a vanilla file, where you're a W-2 employee, you got money in the bank, you're putting it down, you're using your 401k for reserves, and you're buying a single family home. You don't have any other weird stuff going on. You've been at your job forever. Those are what we call vanilla loans. And we love those because they make our life easier. And again, with those kind of loans, much less chance of being denied. So um, hopefully this explains a lot. But what is meant to, for me, my goal in this video was to unpack those things, and so that as you're setting about that dream, getting that dream home, and you're getting your ducks in a row. These are all the ducks that I want you to get in a row. If you got that nice file together and you got all your documentation, you're explaining all your aberrations, you're supporting anything, any letters, if you need to explain anything, that you got odd going on, put all that together. And then when you make that loan application, you give that to your loan officer. A good one's going to ask for most of what I just discussed anyway. And then you got that together, and then now you can supply that, knowing that the odds of you getting a mortgage approval are, really high. And so you're not thinking about, am I going to get it approved? And it'll get done faster, because the cleaner the file, as we refer to it, the faster the underwriter can get through it, make a decision, get it back to your loan officer, and they can tell you congratulations. And there'll be less conditions. Conditions are, they say, we approve you for a loan, but you got to do this. And I can tell you, most of the conditions generated are usually based on lack of documentation, not having the thing. So everything I told you will keep you from getting denied. But even some of those things, if you're missing, you still may not get denied. But you got to come back and get it anyway. And the underwriter, and now that you got to get back in line for them to look at your file again with the new items, because they have to condition you for missing things. They'll say your loan is approved subject to providing this missing thing, or this explanation that we wish you had gave us, or additional thing like that, additional thing. But the income piece, the income part, if you don't have any of the missing income items, they're going to kick it back and tell you we got to have them. A good loan officer is not even going to try to submit it without those things, but they can certainly deny you if you don't provide the income documentation in a timely manner. You will be denied. So following these tips will do that. At the end of the day, make sure you have a low credit, you don't have a low credit score, you don't have a thin credit file. You want to make sure that you don't have a high debt to income ratio, you'll get denied. You want to make sure you don't have inconsistent or unverifiable income. Make sure you got all your documentation. Make sure you don't have insufficient funds for down payment, cash to close, and reserves. Make sure you got all your asset documentation, your bank statements, your retirement statements, your mutual fund statements, and any other cash converted assets that can be used for qualifying. And then make sure you don't have any major financial changes during the application process. You do all of that, and you won't be denied. So there you got it. I mean, those are the essential tips. Um, just remember, preparation and attention to detail is the key. Making sure you're addressing all those deductions on your pay stub. Make sure you're explaining any weird life situations. I shouldn't say weird, but if you got unusual situations going on, explain it in a letter. If you got job gaps, explain those. If you had unemployment, explain that, verify that. If you got laid off and then went back to work, document that. You might have to get a letter from HR. We do verifications of income anyway, independently. The loan processors do. But you still want to be able to explain any unusual situations like that. Do all that, and that severely reduces the chance of you getting a denial. So hopefully you found this video helpful and like it. If you're not already a subscriber, I would ask that you subscribe, but more important, that's good. But more importantly, put comments in the bottom. Tell me what you want me to see. Tell me if you didn't like this video, how I can make it better, how I can make future videos better, I should say. Tell me, what do you want to talk about? I have a couple of more videos in this series about underwriter secrets, to help those of you out there who want to qualify for a mortgage. I'm going to help get you there. But tell me any other subjects you want me to talk about, whether it's pertaining to credit, real estate, mortgage specifically, other credit concerns like car purchases, credit cards. If you're looking for good credit cards for building, we can talk about that. I try not to, I don't really want to do too much endorsement recommendation on these videos because I don't want them to sound like commercials, but you can certainly reach out to me and we can have a conversation, and I can definitely guide you on those things. But again, I ask that you like the videos, subscribe to my channel. That way you'll get notifications every time I create a new video. But I can tell you right now, I'm pretty much putting out at least one video a day, maybe more, depends on what I got to talk about. And then any other topics you want me to talk about, I can definitely do that. And then subscribe, and then share with friends of yours. Because when you click share down there, there's a share button. Social media, similar to other social media. I don't consider YouTube social media, by the way. But in social media, you can share, and then if you got friends in Facebook, you can share there. Friends, colleagues on LinkedIn, and share my videos. That way, hopefully somebody else will find value there too. And then I can continue to help a lot of folks out there in the YouTuber sphere and do that. But I'm rambling on. But again, let me know, please. I like the feedback. Help me make my channel better. Help me make my videos better. And that way I can serve you guys better. So until the next time, God bless and Happy New Year, because this is a December 31st video that's about to be posted. So Happy New Year to all of you guys. You ready? You get into home ownership, but remember, better credit means a better life. Take care. Bye.